What's up, everyone? Sarah here with Tech Monetize Official. Today, we're tackling a topic that rattles even seasoned investors' tariffs. Every week, there's a new headline about trade disputes and import taxes. Most people panic and sell, but what if this chaos is actually a golden buying opportunity? Tariffs sound boring, but understanding their impact on major companies is key to finding value when others are fearful. We'll break down why some stocks get hit harder and how you can use this to your advantage. It's not about timing the market, it's about spotting value when panic sets in. We'll look at 4 companies feeling tariff pressure, but poised for a comeback. Let's dive in. First up, Apple, AAPL, the world's most valuable company, a tech giant that's become a household name across the globe. But behind the sleek devices and iconic branding lies a complex web of challenges and opportunities that investors need to understand. Everyone knows them, but their global supply chain makes them especially sensitive to US-China trade friction. Apple's reach is truly international, with components sourced from dozens of countries and assembly lines stretching across continents. Most of Apple's products are assembled in China, where manufacturing expertise and scale are unmatched. This reliance, however, exposes Apple to geopolitical risks and sudden policy changes. When tariffs hit, costs rise. Every new round of tariffs or trade restrictions can squeeze Apple's margins and force tough decisions. Apple must choose: absorb the cost or raise prices, risking sales. It's a delicate balance. Protect profits, but don't alienate loyal customers who expect premium products at a certain price point. Every tariff headline sends Apple's stock dipping. The market reacts instantly, often with sharp sell-offs that can erase billions in value in a single day. Investors panic, but is the long-term story really broken? Or is this just another bump in the road for a company that's faced adversity before? Apple's strength isn't just hardware. The company has built an entire ecosystem that keeps users coming back year after year. Their services, App Store, Apple Music, iCloud, are high margin and growing, mostly untouched by tariffs. These recurring revenues provide stability and help offset hardware volatility. The brand loyalty is unmatched. Apple's customers are famously devoted, often willing to pay a premium for the latest device or service. Even with price hikes, many customers stick with Apple. The seamless integration between devices and services makes switching costly and inconvenient for most users. Their cash reserves are massive, giving them flexibility to shift production or buy back stock when shares dip. This financial firepower is a safety net that few companies can match. Apple is already diversifying its supply chain, moving some production to places like Vietnam and India. This strategic shift reduces risk and shows Apple's ability to adapt quickly to global changes. When the stock drops on tariff news, ask, has Apple's brand weakened? Has the core business model changed? Has their services revenue vanished? No. In fact, it continues to grow, providing a cushion against hardware headwinds. The dip is about short-term fear, not long-term fundamentals. The underlying business remains strong, and history shows Apple's ability to recover and thrive. Apple's management, led by Tim Cook, are supply chain experts. They've weathered bigger storms, from global recessions to supply shortages, always emerging stronger. If you're investing for the next decade, these dips are rare entry points. Long-term investors have been rewarded time and again for their patience. The market often overlooks Apple's brand power, services growth, and financial strength. These are the pillars that support Apple's continued dominance. Buying the dip is betting on Apple's resilience, not on the latest trade headline. It's a vote of confidence in innovation, leadership, and a loyal customer base. Apple's ecosystem, cash, and adaptability make it a long-term winner. Few companies can match this combination of strengths. Don't let short-term panic blind you to long-term value. The noise of the market can be distracting, but the fundamentals tell a different story. The market's fear is your opportunity. When others are selling, it's often the best time to buy quality. Apple's story is about innovation and endurance, not just tariffs. The company's track record of reinvention and growth is unmatched in the tech world. That's why Apple remains a compelling buy on weakness. For those who look beyond the headlines, Apple's future still shines bright. Next up, let's talk about Tesla, TSLA. the electric vehicle pioneer that's become a global icon. Tesla's journey from a niche automaker to a worldwide force has been nothing short of remarkable, and their ambitions stretch far beyond just selling cars. Their global reach is both a tremendous strength and a complex challenge. Tesla operates on nearly every continent, and their cars are now a familiar sight from California to Shanghai to Berlin. But with that reach comes exposure to global trade tensions. Tesla faces tariffs on essential raw materials like steel and lithium, which are critical for building their batteries and car bodies. These tariffs can significantly raise production costs, squeezing profits. Exporting finished vehicles between regions also triggers import taxes, making it more expensive to get Teslas into customers' hands in some markets. Every time there's news about new tariffs or trade disputes, Tesla's stock price can swing wildly, reflecting the market's uncertainty. Investors worry about squeezed margins, slower growth, and the risk that Tesla could lose its edge if costs spiral out of control. But Tesla's answer is bold: localize production. By building gigafactories in China, Germany, and the US, Tesla sidesteps many tariffs and brings production closer to its customers. Build where you sell isn't just a slogan. It's a strategic move to reduce costs, speed up delivery, and adapt to local markets. Of course, ramping up new factories is expensive and takes time. But for Tesla, it's a long-term play for stability and resilience in a volatile world. Meanwhile, Tesla's lead in technology, whether it's batteries, software, or their vast supercharger network, gives them a competitive edge that's tough for rivals to match. Even if tariffs push prices higher, demand for Teslas remains robust. Customers are drawn to the brand, the tech, and the promise of a cleaner future. Legacy automakers are scrambling to catch up, investing billions in electric vehicles. But Tesla's head start in innovation and scale is massive. So when the stock dips on tariff fears, ask yourself, has Tesla's tech lead vanished overnight? Has global EV demand suddenly dried up? The answer is a resounding no. The fundamentals, rising global EV adoption, Tesla's relentless innovation, and their brand power are still firmly in place. Buying Tesla on a dip is higher risk, but the potential upside is massive if the company continues to execute and expand. Tariffs are hurdles, not roadblocks, for a company determined to transform transportation and energy on a global scale. The market's short-term worries can create long-term opportunities for those who look past the noise. Tesla's network of regional factories and their technological moat are often undervalued in moments of panic, but they're key to the company's future. Buying the dip is a bet that Tesla's vision, innovation, and execution will outlast today's trade headlines and market jitters. For bold investors willing to weather the volatility, that's a risk and an opportunity worth considering. Third, Intel, NTC, a tech giant at the heart of the global chip supply chain and a key player in the US-China tech rivalry. Tariffs disrupt electronics manufacturing, reducing demand for Intel's chips worldwide. Intel also faces direct risks. Assembly and testing in China and Malaysia can get tangled in trade disputes. The stock has struggled with competition and delays, and tariffs add to the negativity. But here's the twist. US policy is now a huge tailwind. The CHIPS Act is funneling billions into domestic semiconductor manufacturing, and Intel is the biggest beneficiary. They're investing over $100 billion in new US factories, building a resilient, homegrown supply chain. This government backing is rare and powerful. Intel's new strategy, IDM 2.0, means they'll manufacture chips for others, opening new markets. The market is focused on short-term risks, but the long-term pivot is transformative. Intel's scale, IP, and industry relationships remain strong. Their new CEO has a credible plan to regain leadership by 2025. Buying the dip is a bet on Intel's turnaround, backed by US industrial policy. It's a classic value play with a government-fueled catalyst. The market's fear is your chance to buy into a comeback story. Intel's future is about resilience and growth, not just tariffs. Finally, let's talk about Caterpillar, better known as CAT. This is a company that's become synonymous with the machines that shape our world, from the roads we drive on to the cities we live in. Caterpillar is the world's infrastructure builder, a true global bellwether whose fortunes rise and fall with the pulse of the global economy. When you see a skyline changing or a new highway stretching across the horizon, chances are Cat machines are hard at work. Tariffs hit them directly. Higher steel costs squeeze their margins, and retaliatory tariffs make their machines more expensive for customers abroad. This double whammy can quickly ripple through their global operations. When trade wars flare, Cat stock often drops fast, reflecting investor fears of a global slowdown and shrinking demand for big-ticket equipment. But Caterpillar's business is built on powerful long-term trends: population growth, rapid urbanization, and the relentless need for new infrastructure to support modern life. Every year, more people move to cities, and the demand for roads, bridges, and utilities only grows. Tariffs create short-term pain, but the world still needs roads to connect communities, bridges to span rivers, and energy plants to power progress. These needs don't disappear because of a trade dispute. Caterpillar's brand and dealer network are unmatched. Customers rely on their legendary quality, durability, and service, even if prices rise. Their global support keeps projects moving. Their global manufacturing footprint lets them shift production to minimize tariff impact. They're also innovating. Autonomous vehicles, advanced telematics, and smart construction solutions are changing the game. Fuel-efficient engines and cutting-edge technology add value, helping justify premium pricing and keeping Caterpillar ahead of the competition. When the stock dips, ask yourself, has the world's need for infrastructure vanished? Has Caterpillar's reputation collapsed? The answer is almost always no. The dip is about emotion, not fundamentals. Market panic can create opportunity for those who look deeper. Infrastructure spending by governments is a direct catalyst for CAT, often leading to surges in demand for their equipment. These projects often ramp up during downturns as governments invest to stimulate economies and create jobs, offsetting trade headwinds. Buying the dip is a bet on global development, urban expansion, and Caterpillar's leadership in building the future. You're buying a best-in-class company during peak pessimism when others are fearful. The world will keep building, and Caterpillar will keep supplying the tools that make progress possible. For patient investors, tariff-induced dips can lay the foundation for strong long-term returns as the world's infrastructure needs continue to grow. So look past the headlines. Focus on the enduring, long-term need to build and the companies like Caterpillar that make it all possible. There you have it, Apple, Tesla, Intel, and Caterpillar. 4 giants where tariff fears can create real buying opportunities. The key is to look past short-term headlines and focus on long-term fundamentals. Volatility isn't always bad. It can be your friend if you know what to look for. A dip in price doesn't always mean a dip in value. Do your research, stay patient, and use market fear to your advantage. If you found this helpful, hit subscribe for more insights on building long-term wealth. Thanks for watching. See you next time.